Hi, everybody. It's time for the I Just Want to Understand podcast. I'm your host, Phil Hawkins, and we talk about all kinds of different stuff here, so sit back and enjoy, and let's get to it. For the moment, Leticia James has dodged a bullet in her mortgage fraud case on a technicality that could be resolved and is on appeal, but for now it's victory for Leticia. Now, she's won a battle, but the war is far from over. So what's the big deal? What exactly did Leticia James do that was so bad? Well, according to the Department of Justice, she is accused of lying about the occupancy of two homes she bought. She apparently, and I say apparently because I have not seen the documents, signed as owner-occupied a house she has never lived in and never intended to live in. She only rented, thereby receiving more favorable loan pricing and underwriting parameters under false pretense. And I'll detail all of this later. Now, if true, this would be the simplest prosecution in American history. Now, how do I know this stuff? Who am I to address these issues? Well, I did 17 years in the mortgage industry. I've been a retail loan officer, a wholesale rep, a secondary marketing vice president, and an advertising manager. I've done A-paper, subprime, seconds, firsts, refinances, purchases, construction loans, takeout loans, commercial loans, land loans, and FHA mobile home installation loans. I've worked for Wells Fargo, Countrywide, North American Mortgage, and other loan companies who have long ago gone under. Basically, there's very little I have not experienced in the mortgage business. Now, you might ask yourself, why is a loan file 2 inches thick to begin with? Well, this is not by accident, because every piece of paper in that loan file is there to protect the mortgage company first and foremost, the servicer, the appraiser, and of course the borrower, among many, many others. Now, the mortgage process starts with a basic form. Now, this form is used in all mortgage lending from time immemorial. It's the ubiquitous Fannie Mae 1003. And this is where you answer questions about your financial situation, your employment history, the subject property, and credit information. This is very, very detailed information you must submit. Your names, aliases, if applicable, addresses for the last 2 years, employment information for the last 2 years. Anyone who has ever obtained a mortgage knows of what I speak. And if you look at Section 5, the declarations page, you have to answer questions about occupancy. In the bottom of this 9-page legal document, it plainly states, and I quote, "Any intentional or negligent misrepresentation of information may result in the imposition of civil liability on me, including monetary damages if a person suffers any loss because the person relied on misrepresentations that I have made on this application." Meaning that if anybody loses money because you lied, you're basically toast. But you could also see fines or imprisonment or both under the provisions of federal law 18 U.S.C. 101 as amended. It's interesting that although she formally pled not guilty to the charges, in no interview or news clip that I have seen has she ever denied that she falsified the 1003. Now let's look now at why this is an issue. We'll examine two mortgage scenarios. One is owner-occupied, and the other is non-owner-occupied. All other borrower qualifications are equal. Only the occupancy is changed, and the loan is exactly the same, the only difference being non-owner versus owner-occupied. Now, here are the terms of the loan. We're going to compare 30-year fixed, 80% LTV with a 20% cash down payment, single-family home, credit score of 725, your purchase price of $625,000 with a loan amount $500,000. Now, all other borrower qualifications are within Fannie Mae guidelines. The date of this quote is December 31st of 2025 on a 30-day lock. And this was provided by a wholesale mortgage company that I am familiar with, and they will remain nameless. Now, these numbers are examples only, meant to demonstrate the difference between owner and non-owner occupied loan pricing. Here is the bottom line. Owner occupied rate, you have two choices: 6 7/8 with no points, or 5 3/4 with 3.5 discount points. Now, that 3.5 points equates out to $17,500. Now, by comparison, the non-owner rate would be 7% with 8 3/8% points. So there's just under $42,000 in increased costs between owner-occupied and non-owner-occupied. Now, there was certainly motivation for her to lie, and according to the DOJ, indeed, she did lie. And again, according to the DOJ, so have many others. Now, here I have to be fair. In my long experience writing, underwriting, and pricing loans, misrepresenting occupancy on the 1003 is probably more common than the industry would like to admit. There's no formal numbers, but the reality is that if a loan is performing, the mortgage company is kind of going to let the sleeping dog lie if they happen to find out that there was a misrepresentation. And especially with legislators who maintain residences in two places, it's tempting, but it's viewed as a victimless crime. But if a mortgage company is found to have fraudulent loans in its portfolio, it's very difficult for that company to function in the secondary. And when that happens, it's goodbye mortgage company and possible litigation depending on the severity of the fraud. So mortgage fraud is a serious issue, and it should be prosecuted when discovered. But it seems to be clear that in this case, Leticia James got busted. Now, she might skate on technicalities, but the originating mortgage company could still pursue legal action or just call the loan, depending on the provisions of the deed of trust. Now, whether or not Leticia James will face justice remains to be seen. But what is clear is we now have proof of Leticia James's arrogance, thinking she could get away with mortgage fraud and use her office to pursue those with whom she disagrees.